Hey, it's Darren with Arbitrage Trade. It is time for Deep Dive with Daniel. How you doing, Daniel?
Good, Darren. How you doing?
I am awesome. And this week, we're going to discuss another financial thing that's happened, and it's changed what's happened over the years. It used to be somewhat seemingly very confusing to now it's just hidden. So we have the auction theory can give you an edge in the markets is the title of this blog that Daniel wrote. So do you want to give the Wyckoff statement or me? Go ahead with your Wyckoff.
I do. Yeah, I actually really love this quote. So it touches on a few things that I believe, and then also things that we talk about on After the Bell. So
Mhm.
the market is governed by supply and demand. It is not the news itself that moves the market, but the response of traders to the news, right? So if you want to break this down real quick, there's kind of two parts, right? So the market is governed by supply and demand. So the way I read that and the way I kind of think of markets is that in the short term, markets are a function of liquidity and emotion, right? So the price of Tesla, over the last week, whatever, is not a function of its fundamental value at all, right? It's a function of how many people are willing to trade the stock at a various price, auction theory, and how they feel about it, right? Because if markets were truly efficient and price discovery was always accurate at its future forward value, they wouldn't trade with the volatility that they trade at, right? So the first part is markets are a function of liquidity, supply, and demand, right? So the second part is it is not the news itself that moves the market, which we talk about, often charts set up in a particular pattern, and then they make that kind of final nail in the coffin move on the news, but the response of traders to the news, right? So it's markets want to move a particular way, more or less, and the news helps fit that narrative to get the market to where it wants to go, which is, once again, a function of liquidity.
Sure. I mean, obviously, if you want to talk to us apes, we always think that the setups are basically where the big investment folks, big investment money gets their money in, and then they let the news come out. Then the retail reacts emotionally to that news, and then they get the rug pulled out from under them. That's kind of the way it works. I'm being very overgeneralistic, but yeah. Either way, it's still supply and demand. It's just a different supply when it's first happening versus when retail decides to come in. And again, which is more emotion. So you kind of hit both right there. So, and you're right. This you may know historically what's happened with the stock, and you may know its range and its channels and everything else. But when you have an event happen, like you said, an earnings call that can just show something just really shoot out of the starting block, and then eventually come back down to reality. That was emotion, right? I mean, that's
Well,
people.
here's a great live example, right? The other
Okay,
day, Tesla had its robo taxi announcement, right?
exactly.
Huge gap, big green candle on that day, up like 8 or so%, right? And in the preceding 2 days, it is now trading at the exact opening spot of that big green candle 3 days ago, right?
Yep.
Has the fundamental value of the future projected value of Tesla changed? No, right? It's actually probably now higher than it was 4 days ago because the potential robo taxi autonomous driving thing is much more realistic now. But
Right.
why would it pop and then go down? Function of liquidity, people buying the stock on the news, selling it when it's, they have all the video of the cars doing now what they're supposed to be doing. So it's a function of liquidity and emotions of how traders feel about the stock. Because I think we can both agree that Tesla's probably going to be more valuable in 5 years than it is today. But
Right.
obviously that was not replicated in the last 3 days of trading.
Yeah, I don't know that I believe in true price discovery anymore. I don't think that is even a thing anymore. But I mean, that's at least it's a talking point going into these different events. So you gave a few examples of auction theory in everyday life that we do. So like eBay and etc.? You want to give those?
Yeah, so like an auction that many of us deal with is like, at least used to. I don't think many people do it anymore. Is like eBay. You bid on it until the
Yeah.
price is, or the timeline is done. You have art auctions. Famously, if you look at the car auctions of people talking fast or something like Sotheby's for art, and kind of the traditional market auction, there's like, you can think of like government bond sales,
Yep.
which is often used as kind of like a metric of how strong the health of like a market is, of how well bonds are selling into it. So it really just comes down to there being an asset and people bidding on how much they're willing to pay for it. Just markets are unique where there's many participants going many directions, where when you think of a traditional auction, it's just up and to the right until it's done.
Yeah. It does look very much like an auction if you go back and look at the old way the market worked. And those guys that looked
Yep.
like they were just one bit away from a heart attack, and everybody's all red in the face, and they're just all waving their arms. It's like, how in the world did he even see that guy when he points at him with whatever bid it was that he had?
I know. How
Or
does he know who
yeah,
he is, who he works for, where to
exactly.
route that order? Like,
It's
it's got
wow.
to
It's
get minutes later after the fact, right?
right, right. So there was a guy that won a Nobel Prize for the theory in the '60s or something that kind of started this whole thing. We'll do that real quick. The history, a Vickery guy or something.
Yes. So,
Vickery.
I mean, William Vickery kind of
Right.
developed the first formal models, and he won a Nobel Prize for it. And then two other guys, Paul Milgrom and Robert Wilson, developed more like real world use cases around online ad slots and things like that. And so, it's just kind of like these guys made the theory around it. But, the traders are the ones that have made the money.
Yep. Yep. And then the next keyword, just tell me what you think about this when I say imbalance, because that's kind of what describes the whole process, right?
Yeah, pretty much. It's, you're looking for an asymmetric position in things to go one way or another. And, you bid on the auction in that fashion.
That's one of the things you outlined was imbalance creates opportunity. So if you know how to look for these situations, then you can take advantage of them. An imbalance in the bidding, I guess, which is what you're saying.
Yep.
Okay, and then that's when your market makers come in and go, "Hey, I can help you out with that."
Exactly.
with
Exactly.
with
They help create, fill, discover that imbalance, call it you want.
Yeah, that's it. And get their bids in before anybody else. No, they don't do that. Never mind.
Mm-hmm.
That doesn't
Yeah.
happen at all. All right, and then I guess I mean, we can get on to the conclusion here because we kind of hit everything. Although you said there's tools and strategies that basically auction theory has inspired here. The volume profile, market profile, order flow tools, VWAP. That's a big one that I've heard when I first started learning about markets. Everybody talked about the VWAP. So, anything you want to throw out there?
No, I mean, these are ways of kind of visualizing that auction theory other than order flow, which is, in my opinion, like why I mean, people trade off level 2 data and make money doing it. But I think
Right,
it's a
right, right.
bit easier to see it visually on a chart. And, there's a lot of things that can be traded around auction theory. And it's even just looking at, chart patterns, right? You see an upside down head and shoulders. It's like, what is that saying? It's like, oh, people want to buy this more than they want to sell it. So it's probably going to continue to go up, right? So you can even
Yep.
think of chart patterns or just a visual representation of what the auction is saying they want to do with this particular asset.
And that's why you have your chartist, as they call them, looking at those patterns to see what's about to happen, most likely. And so, wrap it up on what people who are trading now need to take from this information.
Yeah, I mean, I think it kind of goes back to the quote that we started with, that don't forget markets are made up of emotional people, and the price movement in the stock is a function of liquidity and how they feel about it versus, long-term fundamental value on any given day, right? I
Yep.
do believe that stocks do find some kind of closer to fundamental value over a long period of time, but in any given day or week, whether or not they're trading close to that range is hard to tell. But they trade based on, people and even computers that are responding to people.
Yeah, I was going to say, yeah, it's the computers with the big guys, and then the retail with the smaller volume. Um, and it seemed like there was something else I wanted to say here. Uh, Nah. Well, you know what? I'm not gonna bring in any conspiracy crap on this, so I'm just gonna leave it alone, and
Okay.
we'll go with this. So thank you, Daniel, for bringing this up. Maybe it'll help people that can visualize what's happening, and at least it gives them a perspective of where this all came from, the bid ask, and even people can wax poetic about the old days in those movies we see when they're throwing paper everywhere and trying to figure out what's happening. So thanks for the history, and I look forward to see what you're going to bring it to us next week.
Catch you then, Darren.
All right, Daniel, thanks.